With the best all-inclusive vacation deals to Mexico and the Caribbean, booking your getaway with Cheap Caribbean Vacations means you have more freedom to do your deal. Whether you enjoy snorkeling, endless margaritas, and more, or simply soak up the sun and sand in a tropical paradise, Cheap Caribbean Vacations has your deal for that. Plan and book the exact getaway you want at exactly the right price for you by using our exclusive Budget Beach Finder, or find a featured all-inclusive package to Jamaica and do your deal at cheapcaribbean.com.
And good afternoon. We're doing it live right here. Weekday afternoons at 4 o'clock. We get right down to business on 790 KBC, streaming live online worldwide at kbc.com and the on-demand Mottek On Money podcast, kbc.com, Apple, iTunes, and all your favorite podcast platforms. Big day for SpaceX in Hawthorne, based here in Southern California, with the successful launch of Starship Flight 3, but it was let down instead of liftoff on Wall Street today on the latest inflation report. The final inflation reading before the March meeting of the Federal Reserve coming in sharply above analyst expectations. Inflation at the wholesale level of 0.6%. That was double what Wall Street analysts were expecting. We also got retail sales numbers for last month coming in slightly weaker than economists had expected, rising 0.6% compared with the 0.8% most analysts were expecting. And it looks like a weekly reading on the number of Americans applying for unemployment benefits fell to a 3-week low. The stock market briefly reached for new heights, with the Dow Jones Industrial Average briefly popping into record high territory. But at the close, we saw the Dow down 138 points at 38,906. The S&P 500 slipped 15, and the NASDAQ down 49 points. All the major averages still hovering near the recent record highs. The price of gold, which hit record highs recently, pulling back here now by $1.40 at $2,166 and change. Oil hitting a high point of the year today, right now in after-hours trading, down at 21 cents at 81.05. We're watching a Brent crude in London, by the way, the global benchmark up $1.39 today to 85.42 a barrel. That, too, is a new high for the year, the highest since November. We saw West Texas Intermediate oil move higher today by $1.54, settling at 81.26 in New York. We have seen the oil move up sharply lately, and that, of course, has been impacting the inflation numbers. Fisker, the EV maker, trying to ward off talks of a potential bankruptcy filing, saying it engages with advisors as a matter of course, and it still aims to strike a deal with another car maker. Fisker stock has come under pressure following a report in the Wall Street Journal that the beleaguered EV maker was exploring a bankruptcy filing and had hired restructuring advisors. We see Fisker shares down 16 cents today to 15 cents. We'll talk EVs as well as electricity coming up here later this hour with our go-to car expert, Lauren Fix, editor-in-chief of Car Coach and co-host of the Total Car Score podcast. It turns out that Californians are paying a lot more for electricity than other states. What a surprise, and the finger of blame being pointed at Governor Newsom. I'll talk about that later this hour with Susan Shelley, columnist for the Southern California News Group and host of the Howard Jarvis radio show, heard Friday nights right here on your favorite station, 790 KBC. But first, on your money, the markets, and the economy, I'm delighted to say we have veteran chief market strategist Art Hogan with us on the air here now. Art Hogan, chief market strategist at B. Riley Wealth Management. Art, thank you very much for coming to the line here with so many moving parts on a big news day here today.
Frank, thanks so much for having me, and it's always a pleasure to get in touch with you.
Thank you very much, Art. And everyone was focused on that successful launch this morning, but not so much of a successful launch for the stock market today. Give us your assessment of where things stand here at this point.
Yeah, I would tell you this, Frank. You know, what's been interesting is that the market's really gotten to a crossroads here, and when we entered the year, it felt as though most of the enthusiasm was because the Fed was going to cut rates early and often. And now we're reconciling that with the fact that the Fed might not cut rates as early or as often as we thought at the beginning of the year. But a lot of the reasons for that is that we're getting better than expected economic data. And I think we'd rather be in that latter position. I think the fact that the economy remains resilient, which it has, if you look at the jobs creation number that we saw last Friday, and the average for the last 3 months has been about 260,000 jobs a month created in this economy, 230,000 jobs on a 6-month average. Or if you look at the fact that the unemployment rate has been below 4% for the longest stretch going back to 1969. I think all of those are real positives. So we have a resilient economy. We've got a resilient labor market. We've got a confident consumer. And I think that that is the trade-off we have to pay right now for the market that had once anticipated lower interest rates necessarily. And I think the Fed will cut rates this year. They're just not going to do it as soon as we thought they would and as often as they thought we would. But at the same time, what we're seeing is earnings estimates for the S&P 500 for 2024 have started to inch higher. At the beginning of the year, our estimates, or the consensus estimate, was for about $243. It's at $248 now. We have a $250 estimate for the S&P 500 this year, and that's where we get a target of 5,300. But I think the good news is that we would rather trade better economic data for more rate cuts, and this market is focusing on the fact that good news in the economy can be good news for stocks because it means better earnings growth and better revenue growth. Not necessarily the case today. We've had 3 inflation reports that were a touch hotter than consensus, but not alarmingly so. Whether you look at the PPI today and back out some of the extraneous factors of the CPI on Monday or the PCE last week, I think inflation's heading in the right direction. And the biggest piece of all 3 of those for me was the fact that the owner's equivalent rent, or the shelter cost, finally caved in and started to look more like what we know in reality. The government measures shelter cost with a calculation that's called owner's equivalent rent. And that actually came down a bit for the first time in the cycle. So I think that will continue. I think it's going to take a little bit longer to get to the Fed's target. I think they're going to be patient. But I certainly think by the June meeting, they're going to look at the 5.5% Fed funds rate and say they're too restrictive. So I still think the narrative is the same. The economy is resilient. We're hiring a lot of people. The consumer's confident. The market's going to be okay. But we also went unidirectionally higher from the middle of October into 2 weeks ago. So for the market to take a pause here probably makes a great deal of sense.
On the air live with Chief Market Strategist Art Hogan at B. Riley Wealth. Great to have you with us here, Art, and thank you for that very thorough assessment here. And I saw your tweet on X, formerly known as Twitter, that maybe we need to bring back those win buttons, whip inflation now that we saw back in the 70s with oil now rising and gas prices, by the way, of about 20 cents a gallon here in Los Angeles area, above just a month ago. With all the upheaval worldwide, now energy prices are rising again. When are we going to be whipping inflation, you think?
Yeah, that's a great question. I'm glad you saw that. I am an oddball collector of political buttons, and that was one that I thought I'd pull out when the CPI came out and posted that because it came out a touch hotter. And the comparisons to 1974 when we were going through that program with Gerald Ford and the comparisons now hold no relevance. I think that what's interesting was the number of people that recognized where that came from, and I'm glad you did as well. I would tell you this. Energy prices have been sort of stuck in a range between $70 and $80 on WTI for most of this year and actually arguably for the last 6 months. Now, we broke out of that range, and there's 2 reasons for that. One is that OPEC just extended their quotas out through the second quarter, and I think that was largely expected. But at the same time, I think that the inventory levels that the U.S. Energy Department reported this week showed that inventories are being drawn down. So the supply and demand dynamics seem to be shoring up. We entered this year thinking we were oversupplied with energy product, and that's why we were sort of stuck in the $70 to $80 range. I would argue that the good news is that the increase in the energy price is coming from more demand and less supply than we thought, and that likely spurs a couple of different things. The U.S. is producing more energy product than it ever has. We're at record levels now. OPEC and OPEC Plus, including Saudi Arabia and now Brazil, can take those quotas off anytime they want. They'd like to get to a place where we're in $75 to $85, and I think it wouldn't take much to get there. But at the end of the day, I think that's a very healthy place for both the consumer. I think that's a rational place to be in terms of what gasoline prices cost. And I don't see anything causing us to move to a spike in energy prices in the near term. I don't think the Israel-Hamas conflict is going to spread out and bring Iran into the fact that we lose some of their production. I certainly think there's plenty of OPEC countries that would like to produce over their quotas. I certainly think that the U.S. is producing as much as they can and will continue to do so. So I'm not that concerned about a little bit of an uptick in energy prices. And oh, by the way, some of that is coming from the fact that the energy, oil, and all commodities are dollar denominated, and the dollar has come significantly off its peak. So I think we're in a pretty good space there, but it certainly highlights the fact that energy equities are still undervalued. And I think that we've started to see people sponsoring energy equities. It was the worst performing sector in 2023, and it certainly had a good start to this year. So the knock-on effect of that is people start to recognize that the major fully integrated oil companies like Exxon and Chevron and the North American producers are likely making a lot of money in this range, and I think that continues to be the case. But I don't think we're going to explode out of this range. We may have to shift up to a $75 to $85 a barrel, but it's certainly not anything where we're talking about this is going to go to $100 a barrel.
On the live with Art Hogan, Chief Market Strategist at B. Riley, and we talked to the biggest fans of crypto here, as well as the harshest critics, and certainly it's hard to ignore a Bitcoin hitting record highs recently, up around 73,000 here right now at just below 72K. What are your thoughts on Bitcoin and cryptos at this point?
Yeah, I will tell you this. I think that the adoption rate just accelerated a lot while supply hasn't moved at all. And by that, I mean three things. So first and foremost, everybody waited for ETFs. Well, not everybody, but most of the traditional participants in a new asset class waited for ease of use. So now that there's 11 approved ETFs, and the two largest are from BlackRock and Fidelity, you're seeing inflows continue on a weekly basis since their approval. And that inflows are matching a supply that's constrained. So a couple things happen at supply. First and foremost, when you look at the traditional cryptocurrency and Bitcoin owners, they don't really sell. So the new supply is really hard to come by, and there's going to be an event that's called halving, meaning the crypto miners will get half of the production that they got before this event happened, and that happens at the end of April. So both of those things combined with the fact that you and I and everyone that's always been leery of this as an asset class now have an easy use. We pay 19 basis points to a Fidelity or BlackRock. We buy an ETF. We can buy it and sell it. There's plenty of liquidity. So I think we're just starting to see the tip of the iceberg of this adoption. Now, that's not to say that this is an asset class that doesn't have volatility. It's important to remember that it went to 25,000 and back down to 2,000. It went to 60,000, went back to 17,000. In this recent downdraft, it got down to 25,000. Now it's at 72,000. So remember, it's not for the faint of heart. And if it's something that you want to dabble with, I would keep it below 3% of any part of your portfolio, but it's certainly easier to do now that there's 11 approved ETFs.
And certainly people turn to you for a reliable analysis. When you look at the crypto space, what is considered reliable analysis? We've seen all these wilder predictions where a Bitcoin might go from here, maybe into the $100, $100,000 range. All kinds of wilder predictions, even beyond that. How would you analyze these cryptos, especially Bitcoin?
Well, I would tell you this. I would consider two of the crypto currencies to be the incumbents, and I think that's Ethereum and Bitcoin. And obviously, Bitcoin is the original, and it happens to be the one that's got spot ETFs that are approved. If there were an Ethereum ETF that would be approved, I'd likely think there would be some uptake for that. At the end of the day, it's very much like anything else when you think about it's a speculative asset class. It's not a currency. It's been around long enough that I think we know that there's enough of a sponsorship or fan base that it's going to keep it around for a while. But it's also important to remember it's got a proof of use and a proof of concept and all of those things that come along with this. But to try to figure out where it's going is a very difficult battle. So if you just take a long-term look at the volatility that this particular asset class has, I would say it's not for the faint of heart again. And to say where it's going to go from here, it's hard to say. It's got a limited supply, and it seems to have a new demand. I don't know how much that new demand tapers off when they saturate the market for the people that are comfortable using ETFs. And when that happens, when you see fund flows not going into those ETFs, it likely has the same kind of volatility on the downside. So the one piece of advice that I would give you is keep this in your speculative bucket and never make it more than 3% of any portfolio. If you want to get involved in cryptocurrencies, that's the way I would play it. And I would say the same thing about gold. Frank, we've talked about this forever. Gold is the same type of thing. It's hard to put an intrinsic value on it. Gold is making new highs, but understand that behind that, there's no fundamental rationale for why that is the case. Gold has been around for 6,000 years, and Bitcoin's been around for 6 or 10 years. Just understand that, yes, it's a store of value. It's something that people will look at as, being able to sleep better at night for whatever reasons that you would ascribe to this asset class. But do know that on the crypto side, there's a great deal of volatility.
And nowadays we get to talk about gold chains and blockchain, so that makes it more exciting. Let's talk about good old U.S. Steel. Getting back down to earth here, we see President Biden coming out against Nippon Steel's planned acquisition of U.S. Steel, good old X. That's the ticker symbol on the New York Stock Exchange, stressing the importance of maintaining strong American steel companies powered by American steel workers. We did see X shares of U.S. Steel shares down, what about 6% today? It's being reviewed, I guess, by the government right now, but not likely to happen given the president's comments today. U.S. Steel shares down nearly $3 at 38 and change. What's your reaction to that news today?
Well, I'll tell you this. The reason that Nippon was able to get U.S. Steel to approve this merger was that U.S. Steel has actually lost its way over a course of a period of time. Now, it's been around for, 100 and some odd years, and it's an iconic U.S. manufacturer of steel product, but they've lost their way and weren't operating in an efficient fashion. Now, that said, the reason that you would talk about this not being a good idea for the U.S. would be for security reasons. You want a Japanese company owning an iconic manufacturing company in the United States. That's one piece of the puzzle. But also, running for election in a presidential year, do you want to make sure that the United Steelworkers Union is okay with the guarantees that they're going to be given by Nippon? Nippon made this offer to U.S. Steel before they talked to the unions, and now they're backtracking and trying to make sure that the steelworkers are comfortable with the progress here. I think what the president's trying to do is say, let's just make sure that everybody's comfortable with this particular acquisition. Whether it happens or not, I don't know. And what U.S. Steel does, if it doesn't happen, that's also hard to know, but it's also understandable that in a presidential election year, you're going to make noise about something that is as recognizable as this, a Japanese company taking over an iconic manufacturing company in the United States. U.S. Steel is not even in the top 3 of steel producers in the United States. They're not even in the top 20 globally. They're an iconic brand, but we want to make sure there's some sort of security wrapped around this that the United Steelworkers say we're comfortable with this deal. So I think this is going to take a long time. I bet that the approval by CFIUS drags out to the other side of the election, and then maybe that dynamic changes. But for right now, in the here and now, this is a no-touch. I don't think you want to play this because it's just a political football that's going to get kicked around until there's an approval or this gets pushed back, and it's hard to know what the value of U.S. Steel would be, X this takeover premium that it originally had.
All right, before I let you off the hook here, Art Hogan, let me ask you the big question here. Where are you putting money now and/or taking it off the table?
Frank, I would be shocked if you didn't ask me that question. I would tell you this. So, and the fact that we've been talking to each other for over a decade or more,
2 decades.
I would tell you that, decades. Yes, I'm afraid I didn't want to show your age, but I would tell you this, Frank. The amount that this market has broadened out this year has been impressive, and by that I mean, while the Magnificent Seven has languished, ex-NVIDIA, we're not really seeing explosive upside to any of those stocks that really drove a majority of the gains in 2023. At the same time, we're actually seeing the number of new highs being made in the S&P 500 increase every day. The advanced decline lines are getting better, and there's more sectors that are participating. So I think that continues to be the case. So the equal weight S&P 500, the RSP ETF, is a way to express an opinion that it's not just about tech companies. The other thing that I think is impressive, and not today because there's a lot of volatility in small caps, is the fact that the Russell 2000 has outperformed this S&P 500 since the October lows. and on a 2-month basis, even with today's 2% pullback. I think the market is broadening out, and I think it's an opportunity for investors to start focusing on those things that haven't worked. I would incorporate in that thesis things like energy, which continues to grind higher, industrials, healthcare, and financials. And what I would avoid is chasing any of the euphoria around artificial intelligence. I think that a lot of those companies are fairly priced right now. The companies that have been able to prove the actual revenue opportunity are doing the best, like an NVIDIA. But I just think that some of that has gotten overdone. So it's okay to give those companies a break and let them move sideways for a little bit, but focus on the things that haven't worked, and that falls into the categories of energy, industrials, financials, and healthcare.
Terrific, Art. Well, thank you very much for that thorough update this afternoon. We always appreciate it. Of course, the Magnificent Seven have hit some speed bumps lately, including Tesla and even the so-called Magnificent One, NVIDIA, pulling back a bit today to $8.79 and change, down about $30. And we'll continue to follow all of this closely with you. Art Hogan, Chief Market Strategist at LA-based B. Riley Wealth Management. Art, thank you very much for taking the call here this afternoon.
Always a pleasure, Frank. Thank you very much.
Thanks again. Thank you very much, Art Hogan. And right out to the freeways now, 790 KABC. Friends, if you're hurt in an accident, you need an experienced advocate, and Clark Fielding and his team of sharks at Fielding Law are on standby, ready to dive into your case. My friend Clark the Shark is fearless for justice and your go-to attorney when injured in an accident that wasn't your fault. Whether it's a car accident, slip, trip, fall, or any kind of other personal injury, Fielding Law is here to make sure you get the care, attention, and compensation you deserve. Fielding Law can assess the circumstances of the case, negotiate tenaciously with insurance companies, and if necessary, file a lawsuit and litigate to seek fair compensation on behalf of you, the injured party. An injury is a major disruption in your life. Medical expenses, lost wages, pain and suffering, property damage, and other losses incurred as a result of the injury are all part of the damages. Don't try and handle the process alone. You need an expert in the process, and the team at Fielding Law are the ones to trust. Put Clark Fielding's number in your phone under the word accident. That number is 833-88-SHARK, 833-88-SHARK, or go to clarkthesharklaw.com. Mottek On Money continues here in 790 KABC. Good afternoon. Stocks pulling back. Dow down 138 today at 38,906. We see the S&P 500 down 15 at 5150, and the NASDAQ down 49 points at 16,128. Gold down $1.40 at 2,166 an ounce. Oil down 21 cents at 81.05 after popping to a new high for the year, the highest we've seen since last November. We see in the crypto space, Bitcoin pulling back from its recent all-time high right now at 71,610. We see Ethereum at 38.84 and Doge at the moment at 18 cents. And now the latest news here in 790 KABC. Good afternoon. Mottek On Money continues here in 790 KABC, live on the air, streaming live online worldwide at KBC.com. And yes, the on-demand Mottek On Money podcast, in case you missed any of the shows, right here at KBC.com, Apple, iTunes, and all your favorite podcast platforms. You got the High Stress Express going this afternoon. Here's a shocker for you. Californians paying 140% more for electricity than other states, and the finger of blame being pointed at Governor Newsom. Meanwhile, Californians are bracing for a new electricity plan from Sacramento, and the idea is if you make more, you pay more. The California Public Utilities Commission has until July 1st to impose a new electric rate structure. Watching all of this for you, the taxpayer, is the one and only Susan Shelley, columnist for the Southern California News Group and host of the Howard Jarvis radio show, heard Friday nights right here on your favorite station, 790 KABC. Susan, thank you very much for taking the call here this afternoon.
Thank you. Happy to be with you.
All right, that shocking report here, Californians paying a lot more for everything, and including electricity. Tell us about that.
Well, we do pay something like double the national average for each kilowatt hour of electricity in California, and this is because we have all these green mandates. It was just on your news break talking about how we have to meet these greenhouse gas reduction targets, which are arbitrary and very, very expensive to meet. And when we try to do this by using more solar power, more wind power, it raises everybody's electricity bill because we still have to have natural gas for generating electricity. We still need nuclear for generating electricity. We still need hydropower. Why? Because the sun, I'm going to break some news here on your show, the sun goes down. And every night we need electricity. So we're paying double for everything. That's the reason.
On there live with Susan Shelley. I know you do a great job on social media keeping track of all of this, right? What is your latest posting show about that part of the equation, how electricity is calculated here in California?
Well, on any given day, we can get to about 65 or 70% renewable energy on a sunny, clear day when it's reasonably windy. You can get to about 65, 70% renewable electricity. But that's between 11 and 1. 1 o'clock in the afternoon, it's kind of downhill from there. And by 4, 5, 6 o'clock, we're basically running on natural gas and nuclear. And, of course, once the sun goes down, everybody says, well, we're going to run on batteries. But really, batteries are extremely expensive. They only last for 4 hours. They don't have the technology to get you through the night with batteries. So we get about 5% of our power at the most, 5 to 7 at the beginning, and then it peters off. And by 10, 11 o'clock, midnight, they're at zero. And we're running on natural gas, and we're running on imported electricity, which is just so hypocritical because here we are saying we're leading the nation with our wonderful energy policies, and then in the dark, we're importing electricity from other states, and we don't ask them how they make it. So really, who are we kidding? All we're doing is just paying a fortune to have our picture taken and to virtue signal and to model good behavior for the rest of the country or the rest of the world, which they're not following.
And you're referring to the imperial we, right? Governor Newsom?
Yes, exactly. The imperial we. Well, there's plenty of blame to go around. It was Senate Bill 100 in 2018 by Kevin DeLeon, who's running for re-election at this moment to the city council. He was responsible for accelerating some of these targets and trying to get us to 100% renewable electricity by 2045. Well, in order to do that, there are all these interim goals that either the legislation set or the regulators have set, and everybody has to sign these long-term contracts for very expensive solar and wind energy to show that they're going to be able to meet this target in 2045. This is an exercise in futility. We're never going to get there. There is no path to get to 100% renewable energy. We're going to need natural gas, nuclear, hydropower for as far as the eye can see. And to say that we're not is just wasting everybody's time and money.
Good day to get the pinwheels out, certainly, or whatever is used to collect wind energy today. It's been a very windy day out there. What is that showing on the gauges you're watching?
Well, I'm going to have to pull it up for you, but I can tell you that the cost of upgrading the transmission lines is $26 billion by 2035, because when you build all of these windmills and solar farms, you have to bring the electricity from where it's generated to where you're going to use it. And so that's in your bill also, the cost of putting up all these wires. And a lot of people don't want those wires going through their backyard. So there you go.
Sure.
Right now,
no need to look it up. Okay, you got it. You got it. Go right ahead.
The current wind generation in California is 3,853 megawatts, but the current demand for electricity is 19,000 megawatts. So essentially less than 4,000 megawatts is coming to us, even on a windy day, coming to us from wind. And we have 10,000 megawatts coming to us from solar for a total of 15,000 megawatts of current renewables, but demand right now is 19,000. So what are we doing? Natural gas, hydro.
I remember when former Mayor Mayor Villaraigosa broke ground at a wind farm. I remember we had to be very careful how we said that, but that wind farm to the north of here, I guess, is doing something to help us out, hopefully, today. Now, let me ask you this. California bracing for this new electrical plan in Sacramento. What do we need to know about this? If you make more money, you'll pay more? Where does that stand at this point?
Well, the governor wants it to go through. Many people in the legislature have been fighting it. This was part of a budget trailer bill. They did this in about 24 hours, 72 hours, something like that. They rushed it through. It's one provision in this 20,000-word law that followed the budget in 2022. And it says that the investor-owned utilities, including Southern California Edison, are required to charge they have to divide the electricity costs into a fixed charge and a volumetric charge. So in other words, being connected to the grid and then how much you use. Well, the cost for being connected to the grid has been capped at $10, but now they're taking the cap off because of this law. And the fixed charge for being connected to the grid is going to include all of the infrastructure costs and things like advertising and pensions and fire prevention and insurance and all these various costs. That's in your infrastructure charge. That's in your fixed charge. Income-based. So that will be as high as $128 a month for people who make $180,000 a year for at least one of the investor-owned utilities. They all have slightly different rates. But depending on which of these income brackets you fall into, you're going to see this huge monthly charge. And then a slight decrease in your volumetric rate charge. But, from what? From what it was before or from the latest increase? It's hard to say that people are ahead. And right now, the customers of the investor-owned utilities are having trouble paying their bills. 1 in 5 is behind on their electricity bill. So that just tells you that this is unaffordable and very difficult for people.
Susan, thank you very much for watching out for all of us. Democrats, Republicans, Independents, we're all taxpayers paying for all this. Susan Shelley, columnist for the Southern California News Group and host of the Howard Jarvis radio show, heard Friday nights right here on 790 KBC. Thank you very much for coming to the line this afternoon.
Thank you, Frank.
Right out to the freeways now on 790 KBC. Mottek On Money continues here on 790 KBC. Tough times for some of the electric car makers. Consumers not buying electric cars at the rate the government had hoped, and as well as many of the car companies had hoped. Fisker stock pulling into reverse today in a big way. The company's trying to ward off talks of a potential bankruptcy filing, saying it engages with advisors as a matter of course and that it still aims to strike a deal with another car maker. Fisker stock down today. Let me bring up the latest here. Down 16 cents to 15 cents, a drop of more than 50% today following a report in the Wall Street Journal that the EV maker was exploring bankruptcy filing and had hired restructuring advisors. In the meantime, the Biden administration now, according to the New York Times, expected to loosen its rules for the country's switch to EVs. Let's bring in our go-to car expert now on all this, and that, of course, is Lauren Fix, editor-in-chief of Car Coach and co-host of the Total Car Score podcast. Lauren, it's been a while since we've chatted behind live microphones. Give us your reaction to this big news here.
Well, it's kind of sad. I did drive the Fisker Ocean. I actually liked it. I thought it was a really neat little vehicle if you're looking for an electric car. And I thought it was well designed. It had some very unique features, including the California mode where you press a button and all the windows go down and the sunroof goes open. It was really a unique car. Unfortunately, the sales aren't there, and partly there's a lot of factors involved. And it looks like they're going to restructure. It's hard to tell because obviously I got the same message that you did from their PR agency that, we always hire people and try to restructure, and we're working on raising more money and getting a dealer network, and that would be great. Either way, it's sad, but the industry is sort of in reverse, and part of that is, one, consumers are deciding that they don't want to stand in line waiting for a charge. The expenses and as well as insurance and all that is much higher than that of a gasoline-powered car, and they're looking at hybrids as a great answer because you get the gas and the electric. If you're just running around town and you're doing slower speeds, that EV mode is perfect. And so every manufacturer is starting to do that. I'm actually driving the brand new 2024 Hyundai Santa Fe right now, and we just got back from the drive, and they are offering it in gas and hybrid. And I said, are you going to offer an electric version? They said, we have other electric cars, the Ioniq 5 and 6, but as far as the Santa Fe itself, it's only going to come hybrid or gas. So that tells you that you, the consumer, have made the decision. But on top of that, it seems that the feds are kind of throwing this electric vehicle mandate into reverse, and I believe it's due to the election. I mean, if consumers aren't buying it, they feel they're buying into this or being pushed into something they don't want, this is not the time to push harder because it's going to impact the election. And so we're going to see some changes up to November, but depending upon who wins at the White House, that will certainly impact what happens from that point forward, whether it's a harder push for electric cars and mandating, making owning a gasoline vehicle that much more expensive as well as the cost of fuel, or are we going to go the other way and remove that mandate and let consumers have choice, which is what we want?
on the air live with car expert Lauren Fix. And Lauren, let me ask you this. We just had a chat with Susan Shelley about electricity prices here in California, about 140% higher than the rest of the country, just like gas prices are significantly higher too. Of course, everybody knows that. But the cost, I know you've done a great job comparing the cost of electric compared to gas vehicles. What is your latest thinking on all that?
Well, unfortunately, the cost of gasoline is still a little on the high side, but certainly not what it was. But what we're seeing is, especially California, and I've reported on this, we've discussed this before, that trying to charge consumers based on how much they make is really, I don't know who's making these rules, and the pushback's going to be pretty strong, because it shouldn't make a difference if you've got a family of four and you make $50,000, or you're just two people and you make $50,000. I mean, how are they going to price that out? It should be based on your usage. You use more electricity, you pay more, just like any other product in this world, or service. And I'm really concerned that this is really a bad idea. It's going to cause people to leave the state, and it's a beautiful state with a lot of great benefits, but this raising the price of electricity to this level is absurd.
Right, and Fisker recognized that, and that's why they had that California feature that you mentioned. Though the weather is great, yeah. But certainly other considerations here too. Now, another story I wanted to talk about. This is something that came across as well. Automakers tracking drivers sharing information with car insurance companies. A report revealing kind of a sneaky way car companies are sharing customer driving habits, leading to some drivers seeing a rise in their insurance rates. What do we need to know about that?
Insurance rates are up about 30%. I have reported on this before. I've been saying they've been collecting your data for years, and they sell that data. They sell that data not only to insurance companies, but to the federal government. They sell it to people that sell you things that you're like, I wasn't looking for a new roof on my home or a mortgage or to refinance or extended warranty. All that information is being sold. You don't own that information. When you sign, when you buy a new car, how you sign all these papers and you don't know what you're signing. It's so long and the print's so small, you don't know what's in it. Part of that is the fact that they own the data that's from your vehicle. And with these new software downloads where the information downloads directly to the center screen, like updating your navigation, it's also taking that information and shipping it back to the car companies. So it'd be where you go, when you go, how fast you drive. Did you have aggressive driving in any way, whether it be braking or acceleration? And that's a problem, because maybe something ran out in front of you, slammed on the brakes. Well, that will look like you were driving too aggressively and you had to make an evasive maneuver, and that then goes to your insurance company, and suddenly you've got an increase on your rates to 20-30%, and sometimes even more, especially based on your age and your driving record. This could be a real problem.
So Big Brother is watching you drive nowadays. That is really something,
Yep.
Lauren. Thank you very much for that comprehensive update, and look forward to speaking again very soon. That is Lauren Fix, editor-in-chief of Car Coach and co-host of the Total Car Score podcast, also, of course, on X, formerly known as Twitter. Lauren Fix, thanks again for joining us live here this afternoon.
Thank you.
And let's check out the market action today. Yep, the Dow did reach for new heights. Briefly was in record high territory, but ended lower today, down 138 to 38,906. The S&P 500 down to 15 at 5150, and the Nasdaq down 49 points at 16,128. Bitcoin, which has soared lately, right now hovering just below 72,000. Stay tuned now for the 790 KBC News Blitz with Randy Wang. This is Mottek On Money on 790 KBC.
Get an inside look at Hollywood with Michael Rosenbaum.
Let's get inside of my buddy, Kumail Nanjiani. When you talk about Eternals and it wasn't the response that you were hoping, how did that affect you?
Marvel thought that we'd be going on a wave of raves, and it wasn't true. The reviews were really bad.
And you were aware of it while you were on tour?
Yeah, I was too aware of it. And so very intentionally, I did start counseling. Emily says that I do have trauma from it.
Inside of You with Michael Rosenbaum, wherever you listen.